Hi, my name is Udit and I work in Germany as a finance professional. In today's video, we are going to try and understand what is the formula of success in markets and business, and also is it possible to try and time the market cycles to gain better returns. Let us start with the fundamentals. What is the formula of success in business and markets? The formula is very simple: to buy at a low price and sell it when the price goes up in the market. It is very simple. I have heard a lot of smart people say this about the markets, that they will get in when there is a crash and they will cash out when there is euphoria and positivity in the market when the prices are high. However, the truth is very far from reality. When the situation is not very positive, when the market is going through a downturn, people are scared. They are scared to put in their money. They await for a further crash in the prices. And then when the prices start going up, they think now that the prices have gone up, it has become very expensive. The prices are going to fall back again to the levels that they were earlier on, and then we will buy again. What happens is, at the end of the entire period, nobody ends up buying. You end up buying only closer to the top when there is extreme euphoria in the market. So, this is easier said than done. Our emotions, our feelings don't allow us to take the right actions in the market. Also, practically, I will try to explain with the help of an example that it is very difficult to time the market. There was a study which was conducted by JP Morgan in 2024, which tried to analyze the S&P 500 over a 20-year period from 1st of January 2004 till 31st of December 2023. What they tried to analyze was, during these 5,000 plus trading days, if you missed out certain best days in the market, what was your return? As an example, if you invested $10,000 at the beginning of this period, which was on 1st of January 2004, in an S&P 500 index fund, at the end of the period, which was on 31st of December 2023, you would have ended up with approximately $65,000. Now, within these 5,000 trading days, there was the global financial crisis of 2008 2009, and there was this global pandemic of 2020, wherein the markets corrected. And there were certain up moves and down moves. There was Brexit, there was Trump election. All these things were factored in this period. It was not an easy period for the world like every other period. So this was also filled with global events and uncertainties. Now, during this period of 20 years, if you miss the best 10 trading days, just the top 10 days when the market went up, your returns would have reduced by more than half. The $10,000 that you invested at the beginning of this period would have returned only $29,000 at the end of the 20-year period if you missed the 10 best trading days. So from 65,000, your final amount came down to 29,000, which is less than half of what you would have got if you would have stayed invested. Now, the study further says that if you miss the top 20 days in the market, the best 20 days in the market during this 20-year period, your returns would have only been 1/4 of the returns that you would have made if you would have been invested over this entire 20-year period. So, this $10,000 that you would have invested at the beginning of this period would have returned you $16,000 at the end of the 20-year period if you miss the top 20 trading days. Now, the third most interesting aspect of this study was that if you miss the top 30 trading days, then you would have got only $10,000 at the end of this period. So if we compare these three scenarios, in the first scenario, you got approximately $64,000 at the end of this 20-year period if you stayed invested. In second case, if you missed the best 10 days in the market, you would have got less than half of that amount, which was $29,000. And if you had missed the top 20 best days in the market, you would have made $16,000, which is roughly one fourth of the amount that you would have got if you would have stayed invested. And if you had missed the top 30 days in the market during this period, you would have ended up with the same amount of money. So essentially, your nominal rate of return was zero for this 20-year period, and if we consider inflation, your money degrew. You had a negative real rate of return. So what do we understand and what do we take back from this study? What we take back from this study is that it is very important to remain invested through thick and thin in the market, because it is very difficult to time the market. This 20-year period had more than 5,000 trading days, and out of these 5,000 trading days, we could not afford to miss the best 10, 15, or 20 days in the market, because if we miss them, we will lose out on our returns. So these trading days are less than 1% of the total trading days in the market over this 20-year period. It is very unlikely that somebody could be so sagacious, so wise, so prudent to get in and get out exactly at the right time. And usually these big moves come during the periods of uncertainty, volatility, or downturns. For example, during the COVID phase 2020 March, the S&P 500 fell down by approximately 35% within a month. And over the next 3 months, it recovered by 40%, and then it grew further in the next 3 to 4 years. If you would have missed those best trading days in that period between April to June, then you would have lost a majority of your returns that you could have probably made. And if you remember that period, that was filled with uncertainty, not just uncertainty in the financial markets, but we were also uncertain about our lives, our livelihoods, our jobs, and the future of our world. Imagine trying to put in money at that time where you have no certainty about how the world is going to pan out in the next 30 days. So it is very difficult to time the market, and hence it is very important for us to stay invested, to ride through the thick and thin of the market, to reap the best rewards that it has to offer. And don't trust my words for us. This was the study which was done for a 20-year period for S&P 500. If you do a similar study for major indices in the world, be it DAX or be it Sensex, you will see that the pattern is very similar. We need to stay invested to reap the benefits of the best trading days in the market. Otherwise, we lose out on the major chunk of our returns. So next time somebody tells you, somebody tries to sell you a program to get in, see some charts, see some patterns, and get in and get out at the right time, do it consistently. Trust me, this is very difficult to do it in the long run. You will realize by missing these best trading days, and you will end up paying a lot of brokerage and taxes on the transactions that you are making very frequently. So to evolve as a mature investor, we need to ride the waves in the market. It does not mean that the prices don't impact us. We have to be very careful and mindful of the valuations whenever we are buying or selling any security in the market. This is the very fundamental nature of investing. But also at the same point of time, we remember that the markets can be irrational, they can be volatile, and volatility is the price that we pay for higher returns than the safer instruments that are available in the market for investments. So I hope this video resonates with you. It gives you some clarity about long-term investing. If you like this video, please share it with your friends, subscribe to the channel, and also let me know in the comments if you have any feedback, any suggestions, or you have any disagreements with what I have said here. And also, it is very important to enjoy the investment journey, the life journey, and learn in the process. And I will end this video by my favorite line, which I say at the end of every video, which is, we need to keep walking and remember that growth is life. Thank you.